Imagine you have one $100 bill. Then somebody gives you five $20 bills instead. Now you have five bills. But you do not have more money. You still have $100. That is basically a stock split. More pieces, same total value. A stock split happens when a company increases the number of shares and lowers the price per share at the same time. For example, a 4-for-1 split would be when one share worth $400 becomes four shares worth $100 each. Before it was $400, after still $400, only now you have four shares. The company did not become bigger. Your ownership did not magically increase. The share count changed. The price per share adjusted. So why split the stock? Companies usually split their stock after the share price has gone up a lot. A $1,000 stock may feel intimidating, and a $100 stock feels more approachable. Even if fractional shares exist, the psychology still matters. The business is the same, but the packaging looks easier to buy. It is like turning one large bill into smaller bills. Same value, more convenient pieces. So what does the standard theory tell us? A standard financial theory says that a stock split should not make investors richer by itself. The classic efficient market idea is that stock prices already reflect all available information. Fama, a famous economist, described an efficient market as one where prices fully reflect all available information. So if a split is just accounting, it should not create value. So the classic Fama, Fisher, Jensen, and Roll stock split paper studied how prices adjust to information implicit in the stock split. Their basic finding was that not that splits create wealth, it was that splits may signal something investors care about, like management confidence or future dividends. So the split itself is not magic. The information around the split may matter. Investors get excited because stock splits usually happen after a stock has already done well. So the split can feel like a victory lap. The company is basically saying, our stock price got high enough that we want to cut it into smaller pieces. But do not confuse the signal with the cause. The split is not why the company is valuable. The business is. The split just changes the number printed on each share. Let's take a look at the reverse split. So reverse split does exactly the opposite. Instead of turning one share into several shares, it turns several shares into one. So for example, 10 shares at $1 each become one share at $10. Again, total value is still $10, but a reverse split often happens for a very different reason. Sometimes the stock price has fallen so low that the company is risking being delisted from an exchange. For example, major exchanges often have minimum share price rules. Also, many funds and portfolio managers avoid low-priced stocks or so-called penny stocks. So a reverse split can be a company trying to look more respectable. Sometimes it helps, and sometimes it just looks like a financial gimmick. So here's the clean definition. A stock split is when a company changes the number of shares outstanding and adjusts the price per share without directly changing the total value shareholders own. A regular split creates more shares at a lower price. A reverse split creates fewer shares at a higher price. So simply, one $100 bill becomes five $20 bills, or five $20 bills become one $100 bill. The number of pieces changes, but the value does not. If you like this explainer, please click like and subscribe.